All right, today we're tackling a real head-scratcher, Amdocs' latest earnings report. On the surface, the numbers looked great, but the stock, well, it got hammered. So we're going to unpack this whole paradox and figure out what's really going on and what to look for next.
So here's the deal. Amdocs comes out. They beat on earnings, they beat on revenue, and what happens? The stock tanks, down over 8% after hours. It makes you wonder, right? What on earth did investors see that wasn't in those big, splashy headline numbers?
Okay, so to really get what happened, we've got to look at the numbers first. Because, on paper, this quarter actually looked pretty darn solid. Let's run through the key figures.
First up, let's talk earnings per share. The company posted a non-GAAP EPS of $1.81. Now, Wall Street was expecting $1.75, so that's a nice, clean beat, a solid start. And it wasn't just the earnings. The top line, the revenue was looking good too. They brought in just over $1.15 billion. That also beat expectations, and it's up over 4% from last year. So check and check. Everything's looking great. So far.
And the good news keeps coming. You look at their pipeline, their 12-month backlog, it grew to $4.25 billion. That's up almost 3% from a year ago. What that tells you is they have a healthy amount of business already locked in for the future.
So, a beat on earnings, a beat on revenue, a growing backlog, you'd think the stock would be flying, right? Well, this is where the story takes a turn. The numbers themselves weren't the problem. The real issue is everything else. What was said, and maybe more importantly, what wasn't said on the earnings call. It's all about reading between the lines, and Wall Street did not like what it heard.
It was really like a perfect storm of bad news. First off, after a solid beat, you'd expect them to raise their guidance for the future, right? Nope, they just kept it the same. That's a red flag. Then, they sounded pretty cautious about making money from AI anytime soon. Throw in a surprise announcement that the CEO is leaving, and this is the big one. Confirmation that a huge customer, T-Mobile, is going to spend less money. And all of this is happening when the stock was already struggling, hovering near its 52-week low. Ouch.
And if you want the smoking gun, here it is. This is the quote from management that really did the damage. Even though they just signed a new 5-year deal with T-Mobile, they came right out and said, "We expect a revenue decline with this customer in fiscal 2026 due to a lower level of spending." That single sentence just confirmed a massive problem on the horizon, and it totally wiped out any good feelings about that new contract.
And you have to remember the backstory here. Amdocs wasn't exactly a market darling heading into this report. I mean, look at this. Over the last year, the stock was down almost 15%. Meanwhile, the S&P 500 was up nearly 17%. That is a huge gap. So investors were already on edge. They were looking for some great news to turn the ship around, and they just didn't get it.
All right, so that's the what happened. Now let's look ahead. How does all of this shape the outlook for the next few quarters? What are the big things, both good and bad, that we need to keep an eye on?
When you break it down, it's a really mixed bag. On one hand, you've got this new AI platform, OOS, which could be huge. But right now, it's a prove-it-to-me kind of situation. The T-Mobile deal gives them some stability, sure, but it also locks in a lower level of revenue. The bright spot? Their margins are still really strong. But then you have the CEO leaving, which just adds a layer of uncertainty over everything. It's a real tug-of-war between the positives and the negatives.
Okay, so when you put it all together, the decent but not great results, the cloudy guidance, the questions about leadership, it's time for the next call. What's our rating? Where do we think this stock is headed?
We're rating this one market perform. Look, the company's still running a solid business. Those margins are great, but there just aren't any obvious immediate sparks for growth. With that confirmed slowdown in customer spending and the change at the top, we think the stock is probably going to trade sideways for a while. We just don't see a compelling reason for it to beat the overall market until we get a clearer picture on that AI platform or see customer spending pick back up.
So really, it all boils down to this one big question for anyone looking at Amdocs. Can this new AI platform and the incoming CEO actually jumpstart growth faster than anyone thinks is possible right now? Answering that is the key to figuring out if this stock is a hidden gem or just a value trap.
And just a reminder, this is not financial advice.